in debt, and the bill is rising faster than ever. Every year, many governments spend more than they earn, and to fill that gap between earning and spending, they borrow money. Some of that money goes into schools and healthcare. Some is used to fund pensions and defense forces, and some is spent on rebuilding after disasters or for stabilizing economies during crises. Plus, of course, there are leakages. When it borrows more than the economy can handle, it becomes a problem.
For decades, developing nations were told a simple story: borrow money, build infrastructure, grow your economy, escape poverty. Billions of dollars flowed from Western institutions into Africa, Latin America, and parts of Asia, all under the banner of development. But today, many of those countries are poorer, more fragile, and more dependent than ever. So the question is no longer, did development fail? The real question is, was it ever the goal? This is the hidden story behind World Bank debt and why some loans were never meant to end. When people hear the words World Bank, they imagine a single massive bank, but that's not how it works. The World Bank is a group of international financial institutions created in 1944 in the aftermath of World War II. Its original mission was simple and urgent: to rebuild Europe after the war and to stabilize shattered economies. For a time, it worked. Europe recovered, growth returned. But the World Bank didn't disappear. Instead, its mission shifted. The focus moved toward developing nations, countries in Africa, Latin America, and Asia that were told development loans would help them modernize and escape poverty. And this is where the power structure matters. Unlike a normal bank, the World Bank is owned by 189 member countries, but influence is not shared equally. Voting power depends on how much money a country contributes, and that means wealthy nations, especially the United States and major European economies, hold disproportionate control over decisions, policies, and lending terms. So while the World Bank presents itself as a neutral development institution, in reality, it reflects the priorities of the countries with the deepest pockets, and that imbalance would shape the debt systems that followed. Here's how the cycle works. A poor country borrows money to develop. Interest accumulates. Exports fail to grow fast enough. Currency weakens. Debt becomes harder to repay. So the country borrows again, just to service old debt. Decades pass. The original loan is repaid multiple times over, and yet the country still owes more than it borrowed. This isn't bad math, it's structural design. World Bank and IMF loans come with conditions. Countries are told to cut social spending, privatize utilities, remove subsidies on food, and fuel open markets to foreign corporations. The result? Healthcare becomes expensive. Education budgets shrink, basic necessities cost more, governments lose the ability to protect their own citizens, while foreign investors gain access to cheap labor and resources. Development turns into extraction. Let's pause for a moment to talk about today's sponsor, The Alchemist, a transparent, fully automated trading tool that scans markets 24/7, identifies high-probability setups, and executes trades automatically. But you can monitor everything it does. No black boxes, no hidden logic, no blind faith. If you want a system you can actually understand and control, click the link below and use code WorldBankSecrets for 10% off. Now, back to the system that controls entire economies. Much of this debt isn't even visible to the public. Loans are often routed through state-owned companies, hidden in special development funds, kept off official balance sheets. They're rarely explained to citizens. To the average person, the debt is invisible. Elections come and go, presidents change, but the obligations stay locked in, sometimes for decades. In some countries, citizens don't even know how much their nation owes, who it owes it to, or what was promised in return. And when repayments are due, no vote can cancel them. Debt service comes first, before hospitals, before schools, before public investment. This is how financial power operates quietly, not with soldiers or sanctions, but with contracts the public never sees. Take Zambia. For years, the public believed their country's finances were stable, but behind the scenes, Zambia had accumulated massive hidden debts through state-owned enterprises and foreign lenders. By the time the truth surfaced, it was too late. In 2020, Zambia became the first African nation to default during the pandemic. Hospitals ran out of funding, teachers went unpaid, public services collapsed, yet debt repayments continued. And the most shocking part? Many Zambians only learned how deep the crisis was after the default. So who actually wins in this system? Western banks earn steady interest, often guaranteed, often protected. Multinational corporations gain privileged access to markets, resources, and cheap labor. Consulting firms secure lucrative contracts to advise governments on reforms they didn't ask for. And powerful nations gain political leverage, influence without troops, control without occupation. But on the other side of the equation, developing nations pay a very different price. They lose economic sovereignty. Major policy decisions are no longer made at home, but shaped to satisfy lenders abroad. Budgets must be approved, directly or indirectly, by external institutions before money can be spent. They become dependent on outside approval. A country's future can hinge on a single review, a credit rating, or a debt restructuring meeting in a foreign capital. And when resources are limited, governments are forced to prioritize creditors over citizens. Debt repayments come before hospitals. Interest payments come before schools. Financial stability for lenders comes before human stability at home. This isn't a system designed around development. It's a system designed around repayment. It doesn't reward success, it rewards compliance, and it ensures that wealth flows upward while risk stays local. This isn't charity, it's control through finance. Today, many countries are reaching the edge. Countries across Africa, Latin America, and South Asia are once again facing default, not because they failed, but because the system tightened around them. And this is where China enters the picture. Over the last 2 decades, China has stepped in as an alternative lender, offering loans for ports, railways, highways, and power plants through initiatives like the Belt and Road. To many governments, Chinese loans looked different. Fewer political conditions, faster approval, infrastructure instead of austerity, but they came with their own risks. Chinese loans are often opaque, collateralized with strategic assets, negotiated directly with governments, outside public scrutiny. Now, countries are trapped between 2 systems, Western institutions demanding austerity and reform, and Chinese lenders demanding repayment, leverage, or control over assets. It's a geopolitical struggle for influence, fought through loans instead of armies, and the countries caught in the middle, they pay the price, no matter who wins. World Bank loans were sold as development, but for many nations, they became chains, not through force, not through war, but through spreadsheets, contracts, and interest rates. This isn't a story about bad intentions. It's a story about a system that rewards dependence and punishes independence, because when debt never ends, neither does control. If you found this deep dive valuable, like the video, subscribe for more, and as always, stay curious.